Hey everyone, we need to talk about what just happened in the precious metals market. Silver closed today at 80.71. That's down $4.44. Gold at 46.89, down $200.20. This isn't just another dip. This is day 4 of the worst precious metals collapse since 1980. And while everyone's panicking, legendary investor Rick Rule, the guy who's been in this game for over 50 years, co-founder of Battle Bank, he made a move 3 weeks ago that's looking pretty smart right now. He sold 80% of his physical silver near $80, and what he did with that money is even more interesting. But here's what mainstream media isn't telling you. This crash wasn't random. It wasn't a conspiracy. 3 specific events converged between January 30th and today, February 2nd, 2026, and they created a forced liquidation cascade that wiped out over-leveraged traders. If you're holding physical metal right now, if you've been stacking for years, or if you're wondering whether this is the time to buy or run for the exits, stay with me. Because what Rick Rule is doing right now is very different from what the crowd is doing. And history shows that's usually when real money gets made. Let me show you exactly what's happening, why it matters, and what the smartest money in precious metals is positioned for next. So here's what this means for your money right now. If you bought silver at the January peak of 121.67, you're down 41%. On a $10,000 position, that's $4,100 gone in 2 weeks. If you bought gold at 5,100, you're down 8%. That's $800 per 10,000 invested. But here's the flip side. If you sold physical silver like Rick Rule did near $80 3 weeks ago and moved 50% of that into silver mining stocks, companies like First Majestic, Pan American Silver, the producers, those stocks dropped 15 to 25% during the crash. You took profit on physical, then bought producers at a discount. The math works like this. You sell 100 ounces of physical silver at $80. That's $8,000. You keep $4,000 in cash or gold. You deploy $4,000 into silver miners. When silver recovers to $100, which JP Morgan just forecasted as conservative based on industrial demand, your miners don't go up 25%. They go up 50 to 100% because of operational leverage. Rick Rule has been doing this for 5 decades. He doesn't panic, he rotates. And right now, he's positioned in 3 places: gold as long-term savings, silver producers for leverage, and cash to deploy if we see lower prices. Let me break down the 3 things that happened. First, January 30th. President Trump nominated Kevin Warsh as the next Federal Reserve Chair. Warsh is known as a hawk. He supports an independent Fed. He's not a money printer. Markets interpreted this as the end of the dollar debasement trade. Think about it. For 2 years, gold and silver rallied on the belief that central banks would keep printing, the dollar would weaken, and hard assets would protect purchasing power. Warsh's nomination flipped that narrative overnight. The dollar strengthened. The ICS dollar index, which had dropped 10%, reversed, and precious metals, priced in dollars, got crushed. Gold fell $500 in one session on Friday. Silver dropped 30% intraday. It was the worst single-day move since 1980. Second, CME Group raised margin requirements, not once, not twice, 3 times in 1 month. On January 7th, they hiked gold margins from 6% to 9%. That's a 47% increase in the capital required to hold futures positions. Then on January 30th, the same day Warsh was nominated, they raised them again. Gold margins went to 8% for regular traders. Silver margins jumped from 11% to 15%. Then today, February 2nd, they announced another round of increases taking effect after the close. Silver margins for heightened risk profiles now sit at 16.5%. Here's what that means in plain English. If you're a hedge fund holding $10 million in silver futures and margin requirements go from 11% to 15%, you need to post an additional $400,000 in collateral immediately. If you don't have it, you get a margin call. Your broker liquidates your position. You're forced to sell into a falling market. That's not conspiracy. That's risk management. CME raises margins during high volatility to protect the clearinghouse. But the side effect is a liquidation cascade. Forced sellers create more selling. Prices drop. More margin calls trigger. It spirals. Third, profit-taking after an insane rally. Silver went from 46.90 in early December 2025 to 121.67 on January 22, 2026. That's a 71% move in 6 weeks. Gold rallied from 4,000 to 5,100. When you see moves like that, driven by speculation and momentum, corrections aren't just possible, they're guaranteed. Add Warsh and margin hikes to an overextended market, and you get what we saw: structural breakdown. Now, I pulled up the data from the crash, and here's what stands out. Silver opened Friday, January 31st, at around $110. By the time Asian markets closed, it had dropped to $90. During U.S. trading hours, it fell to $72.63. Intraday range, 119 to 72. That's a $47 spread in one session. Gold opened near 5,100. It bottomed at 44.04, $696 drop, the largest intraday move in modern history. Now, the 50-day moving average for silver sits at about $92. We broke through it. The next major support level traders are watching is $70. If we hold above that, it suggests the panic selling is exhausted. If we break it, we could test $65 to $60, the level silver was at in November 2025 before the parabolic move started. Gold's 50-day moving average is around 4,800. We're below it. The key level is 4,400. We tested it Friday and bounced. If it holds, this could be the bottom. If it breaks, we're looking at 4,200, the level gold traded at in October. Volume during the crash was massive. According to CME data, silver futures volume hit the highest level in 3 years. That tells me this wasn't a liquidity event where nobody wanted to buy. There were real sellers, forced sellers, and real buyers stepping in at lower levels. The Relative Strength Index, a momentum indicator, hit oversold territory on both metals Friday. When RSI drops below 30, it signals panic. We hit 23 on silver. Historically, that's led to bounces within 72 hours. And we're seeing that today. Silver recovered from 72 to 80. Gold bounced from 4,400 to 4,689. But here's the critical part. This isn't the first time we've seen this. Back in January 1980, silver was in a parabolic rally. It went from $6 in mid-1979 to $50 by January 21, 1980. The Hunt brothers were accumulating. Speculators were piling in. Everyone thought silver was going to $100. Then COMEX changed the rules. They implemented Silver Rule 7, which restricted new long positions. Margin requirements were increased, and silver crashed from $50 to $11 in 2 months, a 78% collapse. It took until 2011, 31 years, for silver to reclaim $49. But here's what most people miss. After the initial crash in early 1980, silver bottomed, consolidated, and rallied back to $40 by February. Then the real collapse happened into March and April. Those who sold the first bounce and waited got a second chance to buy at $10 to $15. So where are we now in 2026? Right now, I believe we're in the initial panic phase. Warsh was nominated January 30th. We're 3 trading days into forced liquidations. Margin hikes take full effect after today's close. If history rhymes, we could see a bounce over the next week as short-term traders cover and bargain hunters step in. Silver might recover to $90 to $100, gold to $50,000. But the real test comes in the next 4 to 6 weeks. If industrial demand holds, if central banks keep buying gold, China just added gold for the 14th straight month through December, then we see a structural bottom form. Conservative recovery target, silver to 110 by March, gold to 5,200 by second quarter. However, if the Warsh-Fed narrative strengthens, if the dollar rallies another 5%, we could retest lows or go lower. In that scenario, silver finds support at 65, gold at 4,200. The key difference between 1980 and today is fundamental demand. In 1980, silver was purely a monetary speculation. Industrial demand was minimal. When the bubble popped, there was no floor. Today, industrial demand for silver hit 1.2 billion ounces in 2025, according to the Silver Institute. That's up 11% year over year. Solar panels, electric vehicles, defense systems, every major technology trend requires silver. And about 60% of silver supply comes as a byproduct of copper and zinc mining. When those operations slow down because of economic weakness, silver supply gets squeezed. We're running a structural deficit of about 200 million ounces per year. That doesn't go away because speculators got liquidated. Gold demand is different, but equally strong. Central bank purchases hit 850 tons in 2025. JP Morgan forecasts another 800 tons in 2026. China, India, Poland, Turkey, they're diversifying out of dollars into gold. That's a multi-year trend. Now let's talk about what the big money is doing. Central banks didn't sell during this crash. China's People's Bank added gold in December for the 14th consecutive month. They're not selling at 4,600. They're probably buying more. Hedge funds and speculators reduced net long positions by 18% in the week ending January 24th, according to CFTC data. But they still hold 230,000 net long contracts in gold. At the peak in 2011, that number was over 400,000, so we're not at extreme positioning yet. And then there's Rick Rule. In an interview with David Lynn posted yesterday, February 1st, Rick explained his thinking. He sold 80% of his physical silver near $80, not because he's bearish on silver long term, but because physical metal doesn't offer leverage in a bull market. He took half of that capital and bought silver producers, companies like B2Gold, quality miners with low costs and exploration upside. When silver moves from 80 to 120, a producer's profit margin doesn't increase 50%. It increases 100 to 200% because fixed costs stay the same. Rick kept the other half in cash and gold. Gold is his lifetime savings asset. He's not trading it. But he's watching for opportunities in oil and gas, copper and uranium. Sectors he believes offer better risk-reward right now. Here's what Rick said that stuck with me. We're in a bull market. Don't waste it. In the 1970s, gold fell 3 times by 30% or more during its overall bull run from 1971 to 1980. Each pullback was an opportunity to accumulate. The people who panicked and sold missed the move from $200 to $850. Look, here's the real question. Are you positioned for what comes next? The data shows we're in a correction within a bull market. The structural picture, supply deficits, central bank demand, industrial consumption hasn't changed. What changed is sentiment and leverage. Right now, silver sits at 80.71, gold at 46.89. The next week determines whether this was capitulation or the start of a deeper move. I share real-time updates and deeper analysis on social media. For those wanting exclusive research and early warnings, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the pattern shows the path, and the fundamentals speak for themselves. All right, before you go, 3 quick things. 1. Drop a comment below. Tell me where you're watching from, and give me your prediction. Where do you think silver is headed by end of February? $70? $100? Let me know. 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis 3 times a week. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype, so the algorithm knows you're here for the original. 3. Next video drops tomorrow. I'm covering the one indicator that predicted 2008. It's flashing again. Last time this happened, gold rallied 40% in 6 months. You won't want to miss it. See you there.